In 2008, Tesla had enough money to last one more month. Elon Musk had already spent his entire PayPal fortune, roughly $180 million, keeping the company alive. The first Roadster was a disaster. It cost $109,000, broke down constantly, and took 3 years longer to build than promised. The original CEO was fired. 2 co-founders had already left, and Musk himself was going through a divorce, a public humiliation, and a financial crisis simultaneously. He wrote the last check to make payroll on Christmas Eve. He later said he was crying when he signed it. 16 years later, Tesla is worth $1.4 trillion. So the question isn't whether Elon Musk can build something from nothing. He's proven that 3 times over. The question is what exactly you're buying when you pay $435 for a share of Tesla in 2026, and whether the price makes any sense at all. Because here's what's strange. Tesla's actual car business, the thing that makes and sells vehicles, justifies maybe $80 to $100 per share by any conventional metric. Revenue grew 15% in Q1 2026 to $22.4 billion, which sounds good until you realize the stock trades at 363 times earnings. Apple, with its $94 billion buyback program and 75% services margin, trades at 37 times. You are paying 10 times the Apple multiple for a company that sold fewer cars in 2025 than it did in 2024. The remaining $330 per share, roughly 75% of what you're paying, is not a car company. It's 3 bets on 3 businesses that don't yet generate meaningful revenue. The first bet is Robotaxi. Tesla launched a limited ride-hailing service in Austin in 2025. Paid miles nearly doubled quarter over quarter in Q1 2026. Musk is targeting unsupervised full self-driving in about a dozen US states by the end of this year. But here's what he also said on the earnings call. Meaningful Robotaxi revenue won't arrive until 2027 at the earliest. And around 4 million existing Tesla vehicles need hardware upgrades before they can run unsupervised autonomy at all. That's not a small logistics problem. That's a multi-billion-dollar retrofit program on top of the $25 billion in capital expenditure Tesla is already planning to spend this year alone. The second bet is Optimus, Tesla's humanoid robot. Musk has said he believes 80% of Tesla's future value will come from Optimus, not cars. Production is starting at the Fremont factory this summer. If you believe that, if you believe Tesla builds a robot that can perform factory labor at scale and eventually sells into a market that some analysts project at $5 trillion by 2050, then 435 looks cheap. If you don't, or if the timeline slips by 2 or 3 years, the math falls apart quickly. The third bet is energy. Tesla's storage and solar business grew at triple-digit rates off a small base. It's real, it's profitable, and most analysts barely talk about it. At some point, it becomes a meaningful part of the story. Now the risks, and there are real ones. Waymo has been building autonomous vehicles for 15 years with billions from Google. It still only operates in a handful of cities with strict geofencing. Tesla is essentially claiming it will do in 2 years what Waymo hasn't fully done in 15. One serious accident in the Austin fleet, one fatality that makes national news, could set the entire program back by years and take the stock with it. Then there's the Musk factor. This one is harder to quantify, but impossible to ignore. Tesla sales in Europe fell 38.8% because of anti-Musk sentiment. Not because of the product, not because of the price, but because of the person running the company. A Yale study found that Musk's political activities are now the primary reason prospective EV buyers give for not choosing Tesla. That's not a supply chain problem. You can't fix that with a new factory. And Musk himself is running 6 companies simultaneously: Tesla, SpaceX, xAI, X, Neuralink, the Boring Company. At some point, the question isn't whether he's talented enough. It's whether any human being can give adequate attention to that many businesses at once. Finally, BYD. China's largest EV manufacturer is now outselling Tesla globally, offers comparable technology at lower prices, and is expanding aggressively into Europe and Southeast Asia. The moat Tesla had in EVs 5 years ago has narrowed significantly. So what do the numbers actually say? At $435, you're paying roughly 204 times forward earnings. The analyst consensus price target is 383, meaning the average Wall Street analyst thinks the stock is already overvalued at current prices. 10 out of 34 analysts have it as a sell, which is an unusually high number for a company this size. The base case scenario puts Tesla between 350 and 450 through the end of 2026, rising towards 700 to 1,000 by 2030 if Robotaxi and energy scale as expected. The bull case, where Optimus becomes a real business and Robotaxi expands nationally, puts the stock about 1,200 by the end of the decade. The bear case, where new businesses disappoint and the car market keeps deteriorating, sees it below 250. When you buy Tesla at $435, you are not buying a car company. You're buying a call option on 3 technologies: autonomous driving, humanoid robotics, and distributed energy that may or may not reach commercial scale within a time frame that justifies today's price. The auto business that actually generates cash today is worth a fraction of what you're paying. That might be exactly the right bet. Musk has been written off before. In 2008, in 2012, in 2019. Every time, the people betting against him lost money. But at 363 times earnings, you need a lot to go right, on time, with a CEO whose attention is split 7 ways and whose personal brand is actively costing the company sales in its largest international market. The facts are on the table. You decide.